Hi everyone, welcome to option trading for intermediates. I'm going to be showing you guys how to trade with options in a much more advanced level. So let's get right down to it. Now I'm going to just go straight into what we want to know, and so I won't give any overviews or anything like that. What I'm going to be using for the majority of this video is going to be thinkorswim. Now if you haven't watched my previous video where I talked about option trading for beginners, I highly recommend you to watch that video if you do not have thinkorswim. And even then, if you are not experienced in option trading, I would say to ignore this video for now and just look at this particular video and start off from there. Once you complete that video, then you can come back to this one and then we can go forward with that. So if you're still here, I'm going to assume that you already have thinkorswim installed. And so let's get right down into it. Let's start this thing. Okay, so looking quick at the market today before we really get into options, because they're both the same thing. Remember that options are derivatives of the stock. The S&P 500, which is the biggest index in the, well, really in the stock market, this index has been going up, which shows the general sentiment of the entire market has been bullish. But that doesn't mean every single company is going up. So if we look at maybe companies like Amazon, Amazon has been going up. A company like Apple has also been going up. But let's say like Bank of America, that's also been going up. And then Nvidia, that's also been going up. And finally, let's say Metaverse. So there's quite a bit of stocks that are going up today. However, how can we capture these sort of opportunities? Well, let's take a look at, let's say, Amazon. So Amazon has been going up for the past several weeks. It's been retracing to the 20 moving average over here. And if you're not familiar with moving averages, make sure to watch one of my videos where I explain them, because that's more in technical terms, but we're just going to be talking about options. In Amazon right now, you can spot that Amazon has been going down, but like Amazon and a lot of other companies as well, a lot of companies like Google or Microsoft, several of these companies haven't retraced deeply yet. And that could lead to more fear to enter a sort of trade that you're very bullish, right? Because if the price has been going up a lot, it's quite risky that the price can come back down. And that is possible. But that's why in options, you don't actually have to be exactly right all the time. And that's really what I want to talk about today. I want to talk about a very special type of option that you can create, that anyone can create if you have the knowledge to. And what's so special about this option is that unlike many different trades where, if you're bullish, you have to bet that the price goes up from here. If you're bearish, you have to bet that the price really goes down, that sort of thing. But vertical spreads, you don't actually have to be exactly right that the price goes up. In fact, quite the contrary. Sometimes when you're, and I know this sounds confusing, this may sound very confusing, but in vertical spreads, even if you're bullish, you still can make money if the price goes down. Now, you might be thinking like, how is that even possible? Like that defies logic. How are you making money if the price goes down? Well, hold your horses. I'm going to tell you. And that's why I love options because you don't, it's very flexible. All right. So let's get down to it. Let's explain how to do this. First off, like all the time, in order to really get into options, you have to look at the option chain. So the option chain will be right here on the trade section, all products. Once we look at the option chain, I do recommend that for this sort of strategy, for this sort of option that we'll create, you do want to find and only look at stocks that have a bit of liquidity. So liquidity could be a rule of thumb that you can see for. The rule of thumb that I would say to find if a stock has liquidity or not is whether it has weekly options. When a stock has weekly options, it's more likely to have a bit more liquidity than other stocks that don't have weekly options, because What weekly options do is that they create more versatility for option transactions to occur in a more frequent time. And so that leads to more demand. And that option exchanges are letting the stock to have these sort of agreements because there's a lot of demand in it. But, by that logic, you could say that when stocks don't have these weekly options, then they don't have as much demand, meaning that they don't have much liquidity. But other than that, what's also important is that it doesn't have a huge gap in its spread. So what is exactly the spread? What does a spread mean? Well, in an easier way of saying it, a spread happens whenever the selling price and the buying price are very wide against each other. There's a lot of difference between each other. So let me give you an example. If we look at a stock like Colgate, which is the company that makes toothpaste, look, if you look at their bid and ask, they're extremely wide. They have a huge spread because the selling price for the options are usually enormously different. I mean, look at this. The price to buy the option is $215, rather to sell it is $0, right? What this means is there's a huge disagreement, and there's a huge amount of unliquidity because there's no one narrowing down that price, and that happens often whenever a lot of people are transacting with each other. They come upon an agreement to get an agreed price on whether they should transact the option. In option 101 is that in this because these are really like table graphs, so you can kind of look at it that way. There's columns, there's rows. Well, if we're looking right now at the bid column and the ask column. In the bid column, this is really where the buyers are asking the sellers to sell a price. And then for the ask column, this is the area where the sellers are asking the buyers to buy what they're selling. Okay? That's why it's called the stock market. It's the market. People are buying what others are selling, and whatever you sell, other people will buy. So it's pretty common sense. But however, when there's not much agreement between the sellers and buyers, you get this sort of unliquidity scenario. Okay? That's not what you want, because when you don't have liquidity and you have a trade in an option, one, it's going to be significantly hard to sell those options because there's not much people in the first place who wants your options because there's no agreements. And so even if the price goes up a lot, which is another terrible reason about illiquid options, is that this sort of price wouldn't appreciate as much because there isn't as much demand, leading to real-time price movements. Okay? So it's risky. That's why I stick to just bigger companies, more blue chip companies, just brands that you know. And as I said, just stick to that rule of thumb where you just see that it's weekly options and that you see sort of a narrow spread. Okay? A narrow spread, I would say, would be, let's say in Microsoft's case, it's costing $400, but the options here, if the option here was at $90 and this was at $160, that's still fine enough, right? That isn't fantastic, but that's still pretty liquid. It would be a problem if this was $90 and this was, let's say, $400. Like, that's a big spread, okay? That's sort of the illiquid options you want to stay away from. But anyways, that's just a very important rule. But now let's dive into this technique. I actually want you to do this with me live. So one of the great things about thinkorswim actually is that you can go on something called on demand. So if we go to on demand, what this does is that you're able to go back in history. I want you to go to March 7th, and this is in New York time. I'm just going to keep at this time. Let's see if we can spot anything. All right, so I put at 15:05. That stands for, or 3 p.m., my bad. Looking at Microsoft again, we're going to look at the 15-day expiration on 22nd of March as a weekly option. And what I want you to do is I want you to look at this call. Yeah, this call right here, strike $415. Right click on it. Don't left click, but right click on it. And then go to analyze. Once you see analyze, go to buy trade. And I know that this is a little bit complicated, but just do what I'm doing. Go to single, and it should send you here. So this may not look as different to you, and you don't even know what's going on, but you should really have one right here, which is the option you chose. So we chose 415 strike price, and it was a call. We're not in the trade tab, we're in the analyze tab, and that's what I want. But I want you to change this to the risk profile because we're looking at simulated trades. So let's go to the risk profile and look at this graph. So again, looks very confusing. What does this have to do with options? Well, it's gonna be very powerful, and I'll show you why. So let me give you a very quick explanation of what you're seeing here. This graph is demonstrating the price move of the option, this option that we're seeing in Microsoft. Now, this y-axis represents the profits or loss that you're getting in this option. So, this would be $500 gain, this would be $1,000 gain, $1,500 gain, $2,000, and so on. On this x-axis, that's actually where the share price is at. As the price moves to the right, that shows that the price is moving upwards. And as the price is on the left side, that shows prices on a lower price compared to right now. Okay, so you understand the axis points. Now, looking at the line right here, there's actually two lines that you should have. There should be a green line and there should be a purple line. If you remember in the beginner lesson, I explained that options have two inherent valuation points. You have extrinsic value and you have intrinsic value. A portion of what occupies extrinsic value is the option's time value. So as the option loses time, as it gets closer to the expiration date, that option's theta, its time value, starts to decay. That's what they call it. Or it starts to depreciate. That means that the option's value, the option's worth, is going to be less as time goes on because there's less time. Well, this is what we see here. Exactly on this green line that you see, it's sort of like an obtuse angle. This green line actually represents the profit and loss of this option by the expiration date. So what this means is that if today is March 22nd, which is the expiration date of this option, this is the sort of profit and loss that we should be looking at. So you could see from that we would actually be losing money if the price stays at this level, because look at where this green line is at. Look, if you look at towards the y-axis, it actually loses $500. It loses $500 if it stays there. But if it moves a bit more upward, then it starts to recover and it starts to make more and more money. Okay? This purple line actually represents the current date that we're at. But to be more exact, it's actually representing this date. So let me actually change this a bit because we're looking at March 7th. So this shows and this is actually this is more proper. This shows the current profit and loss of the option right now. So we're not losing. We're losing like $11, but that's because the price is fluctuating. But that's what this purple line represents. And in fact, you can actually see that if you look at this black label that shows up, you can see that there's two dates. There's a purple date, which is today, which is March 7th, being the purple line. And on the green line, it represents the expiration date of the option. It's easier for us to make more money today than it is later. Exactly. That's the point about options. That's the trick about options, that you want to really beat the amount of time that an option can perform as you think it can, so you don't have time really working against you, right? But that's where vertical spreads come in. That's what they excel at, and this would make sense when I'll explain you more about this, because it has to do a lot with this. It has to do a lot with understanding this nature. Let's try to understand this more, because this may still be a bit rough around the edges to you. This kind of looks a bit confusing. So let's clear it up a bit. Let's say that I'm bullish on Microsoft right now, and I believe that Microsoft will go up to $420. So it will increase by $13. Now, I believe that Microsoft, let's say that Microsoft does that today, just for an easy example. Well, how can I know how much the option would gain? You would say, well, if we look at the strike price, it's 415. And if the price goes up by 420, that's really $5 above the strike price. So you're $5 in the money. You would have $500 in intrinsic. Yes, that's correct. And some of you might think that you would actually be making around in total $500 in the option. Well, not exactly. You would be making $500 intrinsically, but you would be making much more extrinsically. Remember? Extrinsic, because we still have time in this option. There's still time until this option expires. So because there's time, what happens is that if the price goes to 420, and you can see this line right here, how much would we be making? Well, instead of really squinting your eyes and see, okay, that's at this level, it already shows it here. So these are the labels that you placed here. Right now we're looking at 420.06, so it's right here. Look, P&L open stands for profit and loss that the trade would have if you executed it now, and we would actually be making $609. You see, I told you that we still have extrinsic, and because we have extrinsic, we're making a bit more money. We're making more than $500. That's the great thing about options in this sort of scenario. But if time passes on, look at what happens. Look at what happens here. When time passes, as they pass, that profit that you see right there starts to diminish itself as you start to get closer to the expiration date. And look at something that's interesting. If you look at this purple line closely, what do you start to notice? It actually starts to behave like the green line, and eventually it becomes the green line. Why? Because it's literally transforming itself onto the green line, because that's the expiration date. That's the profit that will happen when it reaches to that date. That's the sort of rate of change in the value that it will have in that date. Okay?